Weekly stock market update to you all. Let's get on with it. Valuations have come down a little bit, but they're still mainly red. So for those of you thinking, "Oh, market falls, is it a good time to get in based on value?" No, because they're all red. You're paying $27 for a future dollar in profits of Microsoft, or $28 for Nvidia, 29 for Apple. You might think, well, of those three, Nvidia's the one with the most prospects. That might be the case because valuation isn't the only factor. Growth is, for instance. You can see the greens, which are the cheaper ones, but they're not necessarily the ones with momentum or growth. So they're not necessarily the ones that are rising. So let's have a look at some of that. Okay, where are we on the sectors? This is where we are. Utilities continue being the one where you could pretty much pick anything and it goes up. However, I don't tend to try and gamble on the right sector because let's say the market decides that it doesn't like a particular sector for whatever reason. There's a macroeconomic shift, there's new legislation against utilities, whatever. Then the worst ones will actually suddenly perform very poorly because they were always being dragged along by the worst ones. You might say, isn't that the case for every sector? Yeah. That's why I don't gamble on sectors. I look at individual companies to make sure they meet all my requirements instead. That makes life a hell of a lot easier. So how are things? After market close, Wednesday, Meta. I'm going to highlight the ones which could be market moving. Okay. Thursday, Apple, Amazon. Yep. Don't go on holiday. It's a big week. Got it? Friday, anything which could move the market? Not really. There might be some that you own in here that you want to keep an eye on. Now, why do I need to tick value, growth, income, Croaky, momentum, Sortino, alpha? Why do I need to tick all of these boxes? Because otherwise we're taking too much risk. We'd be flying blind. We'd be flying without all relevant information at our disposal. How's the past week been? Well, it's been rather good, contrary to what you might think if you looked at the headlines. Because if you looked at the headlines, you'd say, oh my God, the markets are slumping. That's because major indices like the S&P 500 are based on the size of these boxes. Bigger the box, the more impact on the S&P. The box size is based, of course, on market capitalization or size of the company. So if these big boxes drop, it can drive the index lower. And it takes a lot of these smaller green boxes to make up for it. It's one of the reasons why it's hard for fund managers, for instance, to beat the markets generally anyway. So that's where we are. Let's take a deeper dive into some of these, shall we? Don't forget, by the way, don't forget to follow. Do me a favor, follow these videos. The reason is we have a significant number of people who watch the videos and aren't actually followers, and then they miss them time and again. So over the past year, still a hell of a lot of green. We want to be in a position to take advantage of greens. Things don't just always go up and up and up, as we know. ETFs over the past month, well, you can do your own research on those. There is something of a story about small caps. I can deal with that separately at some other point. Year to date, we've come off a fair bit. So whilst the Nasdaq's up 11%, 14 on the S&P. Of course, the S&P is only a little bit above where it was in March. And you might say, well, after all of that, Alpesh, I had the despair and then the delight and now the despair again. That's how the markets work. D and D. Okay? You can have delight first, or despair, or delight, or despair. You are going to get despair. It always follows delight. In a rising market, the delight is longer than the despair. In a falling market, the despair is longer than the delight. That's how you tell the two apart. But despair follows delight by definition. Got it? So, whilst we're up that much, well, how do you avoid that problem, Alpesh? Several ways you can risk mitigate. You might have less money in a lot of different instruments. That way, any drawdown, you're less impacted by. In my experience, even if somebody's got £5 in something, they look at the percentage, not the absolute amount. So you might say, well, I'll only look at these once a year. Basically, I'm not going to exit anything unless it drops 25% from the price at which I bought it. That's one way to do it. So stop looking at it. All right? You can't be in a car and say, I don't want motion sickness if motion sickness is what you get if you're in a car. Now, sectors, they're all up so far this year. They're all up. Every single sector is up. I don't gamble on individual sectors, but I'm just saying every single sector since the start of this year is up. So if they're all up, how come I'm down? Well, you might have got in at the despair point first. And always assume as soon as you buy something, you are cursed. Sod's law applies to you. It will fall as soon as you buy, and you're going to get the despair first. But in a rising market, the despair will be shorter than the delight, and the delight will return. So don't panic. Where else are we on all of this? This is where we are. The factors. Which factors are leading the way? Momentum, growth, and value. Well, we tick all of those boxes. Okay. And if you're, by the way, if your pension is stinking and stinking awful, please have a look at the campaign for $1million.com. My campaign to teach 1 million people how to invest better. There's a hell of a lot of free tools on there, including free copies of my book, free portfolio review, free to follow me on LinkedIn, free copy of my Mind of Trader book, which is published by the Financial Times, free trading classroom, free investing course, free daily investment telegram, free investing videos, free latest trading videos, free latest investing webinars, latest market articles, free investing and trading newsletter, free investing and trading podcast, career advice, free videos on that as well, free bank forecasts as well. Okay, so do have a look at that. It'll sort of teach you a heck of a lot of stuff. And 31 minutes ago, that was just posted. That's good. A lot of my articles on there, which are bang up to date. So do have a look at that. Now, let's get back to business. Okay. Markets over the past year, this is where we are. Nasdaq's up 20%, S&P 18. Alpesh, I didn't like the despair, delight. I don't like all those ups and downs. Fine. Don't look at it then. Once you enter, whatever instrument it is, don't look at it for 12 months, or if it drops 25% from the peak. From the entry. That's one way to get around the problem. Okay? Simple. Just don't look at it. And you just tell your broker, if it drops 25% from the entry, then please get me the hell out of there. That's it. And then ignore the headlines. It's closer to what Warren Buffett does. FTSE 350, the stocks and their rises over the past 1 month. That's how they've done. Okay. And we'll come to some of those. That's, as somebody said, it's not a dead cat bounce as much as a cat wrapped in concrete. They've announced that they're going to bribe their people to sell their products even more, give bigger kickbacks, basically. Somebody wrote on my TikTok, they said, St. James's Place is so noble. They never complain. They never apologize, as if they're somehow regal because it's at St. James's. Actually, they apologize quite frequently after the Times articles and when the regulator says to them that actually you've overcharged, and they set aside hundreds of millions in compensation. So they do it quite frequently, actually, their apologies. So for those who think, they never reply back to these criticisms, they actually do reply back to the criticisms when forced to. S&P 500, where are we on this one? Well, that's how much it's down, which is typical of a baby bear. A baby bear is basically when the MACD is still rising. Now, it's done this before. These drawdowns are common. Drawdown depth, you look at the depth and the duration as a good indicator of what's going to happen again. Okay, so that's where we are at the moment. Is it likely to continue falling? Well, more likely to fall than rise, given that it's overbought. However, maybe the case is more likely to rise because it tends to rise more often than not. Okay, so statistically, actually more likely to rise. August, most of the time, isn't a positive month, and you make nothing in August, and in September, it's even worse. So maybe we're due for a couple of months where the baby bear becomes the mama bear. Right, where that falls, and that's where you get more of a 10% drop. I'm going to talk in the next part of the weekly stock market update about NASDAQ and individual stocks. Okay.